Okay, let's go ahead and get started today. I know there will be a number of people joining us as we go along. We just talked to Dwayne, and he's got some things he's got to take care of. And so we'll just go ahead and start as people come in. I'll just mention for the record, go ahead and this is an informal conversation. And so it's meant to be informal. And so, go ahead and let's see your smiling faces. Put your camera on if you can, and unmute your mics unless you've got a really noisy background. And say hi, and we'll greet you as you come in. So tell me, we've got AAS Management. Who are we talking to tonight?
This is Anthony.
This is Andy. Okay.
Anthony.
Anthony.
Yeah.
Oh,
hey,
Anthony, how you doing?
Doing good. How are you, man?
Good. So it's funny because when you first came on, the lighting on your camera was such that you looked like you were wearing a mask. And I was thinking, oh my goodness, I'm talking to some terrorist or something.
No, it's me. It's me.
Oh, well, that's good. Good to see you again.
You too.
So we have quite a few people who probably will be joining us. So I'm just going to go ahead and get started.
Okay.
Feel free.
Mute out.
If you want to mute out, you can mute out. If you want to jump in and add something, feel free. This is an informal discussion. I do prepare a presentation simply to give us something to talk about in a guided sort of way. But if you've got a question about what we're talking about, or if you want to add to what we're talking about, feel free. This is informal. You won't offend anybody. Just jump in and tell us that you've got something you want to add. So, but with that said, I'll go ahead and start. And then, like I said, jump in. So we're going to be discussing chapter 2 of The Shadow Banker's Secrets. That's Ben's book. We're focused on his second edition. Chapter 2 is entitled The Golden Rule, which is the path of the shadow banker. And so it's designed to kind of show you what the opportunities are, what the opportunities are like out there in the shadow banking world. Some of these things you may be familiar with already, or this may be a new exploration for you as far as exploring what the industry is like and what opportunities it offers you. And so these are some of the kinds of things we'll be talking about tonight. So we're going to be talking about the golden rule. The golden rule in this industry isn't he who has the gold makes the rules. That's what a lot of people think the golden rule is, right? He who has the gold makes the rules, or he who has all the money makes the rules. But that's not true. Let's see if I can, there we go. I've pulled this down. I think, there you go. It's whoever understands money makes the rules. And so that's the key here. And that's really the premise behind Ben's book, behind his masterclass, and his whole approach to education is to help us understand the rules associated with how money is made. And then we can live by those rules, and we can participate in that shadow banking economy that he's referring to. I'm going to see if I can play with this gallery here just a second to see if I can get it so that it's smaller and not taking up so much room on my screen. There we go. I want other people to be able to join in the gallery, but okay, so we'll go with that for now. So anyway, that's the key. That's the golden rule. Whoever understands money makes the rules, not whoever has the gold. So that's kind of a paradigm there that a lot of people need to have. This is a paragraph out of chapter 2. And it's basically, it's interesting. I was talking to somebody the other day, and I told them about shadow banking, and they go, "What's shadow banking?" It sounds kind of, I don't know. Maybe the word is kind of shady, since shadow shady, but it's actually a technical term. And so, I've put some samples here on this screen that show who some of the big shadow banking companies are. And then, of course, I added Adagio. Adagio may not be as big as BlackRock or Morgan Stanley, but we're certainly working with a group that has the potential of becoming that large. So let me just read this for you real quick. The shadow banking system or shadow financial system is a network of financial institutions comprised of non-depository banks. That's the key, non-depository banks, such as investment banks, hedge funds, structured investment vehicles, money market funds, and other non-bank financial institutions. Shadow banks are called such because they operate outside or in the shadows of the regulatory framework that governs depository institutions. So in other words, if you're not taking deposits like a regular retail bank or a commercial bank, like your Main Street bank that has savings deposits and checking accounts and all those kinds of things, they are regulated by the banking system, the banking industry. Whereas these investment banks and hedge funds and non-depository banks are regulated more or less by the SEC. And so there's a very careful distinction there so that you're only regulated by either the SEC or the bank, the Fed and the banking regulatory agencies or the other, but you're not crossing those lines. And so they refer to the non-depository institutions as the shadow banking system. So these are all institutions you've heard of before. So let's talk about briefly then what the dynamic of the shadow banking system is. In other words, just a real quick drawing that gives you an idea of what we're creating. Because we talk about a lot of these pieces and parts in these presentations and in our other discussions, but I want to give you some visuals, some dynamics to give you an idea of how it looks and how we fit together. So the banking system dynamic, the shadow banking system dynamic, is typically we're working with investors. They have cash. They put that into a shadow banking institution that sells a security in return for that cash. And so the shadow bank, let's say that's Toby, hi. Let's say that's Toby or Anthony here. They set up an LLC to receive that cash and sell that security in that institution, that shadow bank. And they issue, the security they issue is a preferred stock, a share of preferred stock or multiples of that. And then, of course, the shadow bank then receives that cash and they invest it. And so that's really the dynamic between investors and shadow banks. One of the things that we're going to talk about is how we're creating wealth in this process. Because similar to a depository bank, we have our ledger for the shadow bank and the investor has his ledger for, his investments and his cash. And so we're literally creating through the process of creating a security that we then sell to the investor, and that security has value based on that sale. We, like regular banks, are in the process of creating money. Or creating an instrument that can function as such. And so how does that look? On the investor's ledger, if you can imagine he has a ledger, he's got an asset. It's cash that he has converted to a security. He still records that security as a current on his balance sheet, or it might be a longer term asset if it's something that has to stay illiquid for more than about a year. But the same thing happens on the shadow bank side, because at that point in time, having sold a security, they now can put that cash on their balance sheet and then invest that cash into projects and things like that, and have those cash investments be recorded on their balance sheet as assets. So it's not quite the contrived accounting machinations that you have to go through to create money out of nothing, or to do a fractional reserve type banking structure that the depository banks do. But it nevertheless is a process of compliantly creating money and making that available to invest, and therefore creating more wealth. So that's the significance of this dynamic. I hope I have. Yes, I have. Okay, good. All right, so let's continue on. Again, Toby, Anthony, feel free to jump in and make any comments as you wish here. So the question now is, who is shadow banking for? Who can benefit from participating in this shadow banking world? And so, there's all kinds of professionals that are tangentially related to this industry. And so, for example, you've got over here, you've got investment managers, investment professionals. Those are, RIAs. They're FINRA licensed. They might be running a family office. They might, have investment type clients, right? They can get involved in this, obviously, and instead of basically brokering their clients' money and putting them into other funds and things like that, they can literally set up their own funds and learn how to do it through here. Or we can set up funds and they can put them into our funds. But that's something that we can do, is maintain relationships with those kind of professionals. Obviously, retail investors up the top here can benefit from this work that we're doing, both from an education standpoint or from also an investment standpoint, because that's ultimately what we're hoping to do with our funds is have retail investors put their funds with us and allow us to invest that money for them. But at the same time, if they are like the people down at the bottom here, marketers and relationship builders, these could be one and the same person, and they could again set up their own funds for their investment purposes. In other words, it almost begins to resemble that of a family office. Coming over here, you've got financial professionals. I may have those doubled up. I was thinking investment managers and financial professionals are one and the same, but again, these are your licensed investment professionals. They could be salesmen in the maybe they're selling mutual funds. Maybe they're selling other financial related products that appeals to their base. And again, setting up their own funds or investing with us in our respective funds, they can be involved in this process. They're already involved. It's just a matter of getting involved with us. Real estate professionals. Again, those are people that know about good real estate deals. If real estate is an area where they want to invest their time and effort, they can find great investment opportunities for investors. And so if real estate professionals wanted to set up funds for which their clients and others could come in and invest in those real estate projects, that's a great opportunity. I'm going through this kind of fast, but you can kind of get the idea that you can get a lot of people involved in these kinds of things. And, depending on what you want to do, you can bring a lot of people from a lot of different places into the shadow banking system. As I mentioned, marketers and relationship builders. These are people who already have big networks, and they could profit by offering a fund to these networks of theirs and bring, and monetize, if you will, their network by building a business around it. And so that's something else. Of course, they can get involved with your fund, or you could help them make a fund, with respect to what you're learning how to do. Then the last little group over here in the lower left is everybody else. There's independent insurance agents, IRA custodians, accountants, and attorneys. They all have client bases and they all know people, and they can either jump in and learn how to set up and operate a fund and take advantage of that network. Again, do it compliantly and profitably, or you get to know these people and they will send you clients. And you can definitely make it worth their while for sending you clients and that kind of thing. So, this is for these kind of people. And if you fall within that group of people, then this is definitely the place for you. I got a chat. Let's see if somebody's got multifamily syndicators. Absolutely. In the real estate space. Thanks, Toby. Okay, let's go to the next slide. Oop. So, speaking of syndicators, we can talk about here what syndicators do versus the financial institutions. If you've ever been involved in a syndication, then this would be a really good alternative to syndicating. Because many syndicators are limited as to what they can accomplish. Whereas if they turn their projects into a financial institution or create a financial institution around their projects, they can find that they've got a lot more advantages to work with. And so let's just walk through what some of this is. I'm going to move this to the side, and then I'm going to see if we can't go through this chart a little bit. So, on the what, syndicators are not financial institutions, but hedge funds and private equity funds and investment banks are financial institutions. And so, when you compare them to syndications, if you look at a syndication and what it is, they sell closed-end partnership interests. They sell shares in a project. Whereas if you're a hedge fund, they sell open-ended partnership interests or shares in a strategy based upon a portfolio of equities and derivatives. Okay. Or if they're, and they can be the syndication could be for a real estate project. It could be for a private equity project. But typically the defining of the what is closed end, and it's a single project. So when we jump over to private equity funds, they sell closed-end partnership interests or shares in a strategy based on a portfolio of companies. So it's similar to syndication, except it's a portfolio of companies in this case. And then the investment banks, what they do is they actually sell the securities they underwrite. And so that's the what. How do they do it? Well, the syndications sell a story predicting future performance based on the market. And if you've ever been involved in a PPM that is selling a Reg D offering for a particular company, or a real estate deal, or any of those kinds of things, that's exactly what they're doing. Is they're selling a story. Been there, done that many times, and we're predicting the future. We're looking through our crystal ball based on what we think the market is telling us. And so that's an important distinguishment there in terms of what a syndication is. Hedge funds, on the other hand, they're selling market neutral historical performance. In other words, we're going back and we're looking at how they did historically. And if we don't have a history, then we're rigorously creating a rigorously created back testing. Private equity funds are selling the ability to turn around and grow in companies and exit. So in other words, the key to success there is to do the turnarounds and to grow them and to buy them for a very, very low price and then turn around and increase that value and then sell it off, right? Investment banks, we sell expected performances based on securities issues. That's the securities it's underwriting. So who's involved in these types of institutions? On the syndication side, They sell their private issues to individuals based upon personal and trust-based relationships. It's all about who you know, right? And that's why, you know, the syndicator has a multi-million-dollar Rolodex. Hedge funds sell their private issues to sophisticated and institutional investors based on merit, okay, how well the fund is actually doing. Private equity funds sell their private issues to sophisticated and institutional investors based on merit, again, how well they're doing. Investment banks sell structured products and client company issues to sales and trading clients, and according to their specific needs or appetites, as Ben says here. Why do they do this? Syndicators, they profit and crash with the market. So if the market's doing well, they do well. If the market's not doing well, they're going to have a tough time. Hedge funds, they profit from their ability to generate consistently strong performance regardless of the market. In fact, you know, this is where a lot of people, when they want to get out of the market, look to go is to hedge funds to see, you know, if they can protect their money from the market fluctuations. Private equity is very similar. They profit from an ability to generate constantly strong performance regardless of market. And then the investment banks, they profit from the advisory fees and the broker-dealer function. So that gives you an idea of how syndicators operate versus financial institutions. And so I guess the moral to the story for this page is basically syndicators. Consider setting up a fund. Don't do syndications, but set up a fund, one that's regulatory compliant, and then demonstrate that you can manage that fund by managing the risk. Okay, let's go on, unless there's any questions or comments. Oop. I want to make sure I haven't skipped anything. Nope, so far I haven't. So this is the adagio dynamic, and I would say this is also fairly common for the industry as a whole, but I mentioned the adagio dynamic primarily because Ben has put this particular visual together, and I want to give him the credit for it, but also because as we are working with Ben and working with Adagio to set up our funds and manage our funds, this is the structure that we can visualize as we are putting this together. So as you'll notice here, I've added a couple of things to the dynamic because essentially this is where, well, I guess I just ought to go through it. So on the right, you know, we have here the orange box, and those are our institutions, our investment clubs, our funds, okay, that we're setting up. I know I put the little arrow there that says your fund goes here, and I probably made it look like it's going between the orange box and the investors, and it really isn't. Your fund is the orange box. Whether you do an investment club, whether you do a fund of funds, whether you do a 506B or 506C, it's that orange box. And so that's your fund. Now, just to be clear, Ben has gotten more clear in the last few months where you can come in and you can kind of act like a kid in a candy store and say, oh, do I want to do a 506A or a B or a C, or what do I want to do? Do I want to do a hedge fund, a private equity fund, real estate fund, you know, all these kinds of different things. And what Ben has finally come out and said, with all the people who are, you know, exploring all the possibilities, like I said, we're all acting like kids in a candy store. He's basically said, look, guys, do a fund of funds. For starters, just get started with a fund of funds, which allows you to be very flexible, asset agnostic, and put your money your investors' money in a number of different types of projects. It allows you to kind of see what you like without making a commitment to it. And so we're really highly recommending people do a fund of funds to start. The other thing is that the rules with a 506B can be somewhat, I don't want to say complex because I don't think they are, but they can be somewhat challenging to uphold. And so Ben is really recommending the investment club on one end, or maybe a 506C on the other, depending on your level of understanding and the amount of complexity that you want to put on it. It depends on whether you're FINRA licensed or not in some cases. So when you look at the differences, just briefly look at the differences between a 506A and a 506C, and just stake on one of those or the other, either the A or the C. And he's recommending the A for a lot of reasons, and we won't get into 506As today. There are other archived videos that we have in the community that explain what a 506A is versus a 506C. Feel free to go check those out, and you'll see the differences. But pick one of those, and then proceed to set your fund up. And we're talking about those. In fact, a big plug for our other Tuesday night meetings are that in those meetings, we go into some of the details. We go into more of the mechanics of how to set those up. And not only that, but to help you as the attendee in that Tuesday night lab, we can answer your specific questions and talk about your specific issues and questions to help get you to the next level. So I've kind of gone down a side trail here, but that orange box is you, the fund owner, you, the fund manager. And so stepping further to the right, then these are all the investors that you will have investing in your fund. Now, stepping more toward the left through the dark blue box, which is Adagio, that's the investment bank, that's Adagio. They have the sell side contracts, and then they have the buy side contracts. And that's simply nothing more than when you put structured products into your fund that you've acquired from Adagio. Go back to that other dynamic for a second. You're buying an investment or a security in exchange for cash. So what you're getting is you're getting an interest in a structured product, which is just another name for a fund, another fund. That's why you want to make this a fund of funds, because when you put $1 into a particular fund at Adagio, you're buying into one of the funds that they've created for a specific purpose. And again, as we've discussed many times, these are your safety nets. And so you're going to decide what percentage or how many cents in each dollar are you going to spend or invest, shall we say, into Adagio structured products, Adagio funds, in order to set up your safety nets to ensure that your investors get the kind of return that you are promising and they are expecting. And then with the other money, now you can go out and invest in other funds, other things that you want to invest in. In fact, Adagio will help you set up structured products around those projects so that you can do that. And again, make sure that they're safely structured so that you can ensure that your investors are making their returns. Now, on the far left side, you see that there's buy side. There's money going out from Adagio into other projects, alternative asset managers. This is where they're providing money for specific projects. Let's say, for example, you're running your fund, you've built your Adagio safety net, you've got half the money invested in Adagio structured products. Now you've got another fund that you want to create, or a structured product you want to create around, let's say it's a mega multifamily real estate project. And so, you now take that project to Ben and you say, Ben, I've got a mega multifamily real estate project I want my fund to invest in. Let's create a structured product around this so that it's safe and it's going to guarantee the kind of return that I want to make. Okay. And he says, great, let's do it. And so let's say your project is $100 million. All right. So he'll create a structured product around that multifamily, super mega multifamily project. And let's say you put $25 million into that. Well, it needs another 75 million. Well, this is where now your project becomes that light blue box over on the left. In other words, it's a project that you want to invest in your orange box, but now you're taking in dollars from other funds. In other words, let's say Toby is setting this light blue box up. And so I decide I want to put $50 million into that project. And Anthony here decides he wants to put some money into that project. And Frenchie decides he wants to put some money into that project, all based out of their own funds. Okay. Then essentially that money goes into Toby's fund to complete that $100 million project. So Adagio is playing both sides, as you can see there. They're providing products to put into your orange fund, and they're also providing capital to come into your blue fund that you're creating to go into your orange fund. I hope that doesn't sound too confusing, but it's basically where we are taking advantage of both sides of the services that Adagio offers. Does anybody have any questions about that? I know that might be a little bit tough to get your head around the first time around. So feel free to unmute yourself and let's see your smiling face, and feel free to ask a question there before I go on. Anthony, I need to have you unmute your mic, my buddy. There you go.
Okay, sorry about that.
Oh, no problem.
Yeah, so I was just asking, because I've been listening in and out as I've been finishing up work. But so he helps us with the distribution of our product as well. Am I clear on that?
If it's a product that passes his underwriting, I failed to mention that. He spends a lot of time. In fact, we're going to spend about a third of our time this year talking about the underwriting requirements, the risk-adjusted performance measures, right? So yes, the answer is yes, Anthony, you're correct, with a qualification. And that is obviously we've got to make sure that our project and its safety nets all combined make for a product that will get the returns and meet the standards that we're looking for. And so not just any old project will do. There is just that. You want to line your fund, that your orange box, with safety net products, the structured products that Adagio makes. These could be GP stakes. These could be other types of alternative assets. And then when you go out and you decide, okay, I'm going to spend the rest of, let's say you put 50 cents on the dollar in there, and I'm just pulling that number out of the air, but it's kind of a ballpark number that I would think would be conservatively well, right? And that's because if Adagio is so far this year, Adagio is pulling down a 50% return. And so if you put 50% of your assets in your fund into Adagio this year, then if you made nothing on the other 50%, you're still going to make overall portfolio wide 25%, which is a dang good return. It's not a perfect return, but it's a dang good one. You're not going to have any upset investors, right? Unless you promise them more. But if you are careful about what you promise, you under promise and over deliver, a 25% return is just fine. Okay, so that's what I'm saying. If you put 50% in there, and they're making a 50% return, you're making a good baseline return for your investors. Now you've got 50 cents on the dollar to invest how you want in other funds. Okay. So let's suppose, like I said, you find this big mega multifamily project. Okay. And you take it to Ben and you say, Ben, it's $100 million. And I've got 25 million I can put into it. I'd really like to see this project come through. And Ben does some numbers, he does some underwriting, and he says, yeah, this is a really great project. I'd like to build a structured product around this project. Okay. So Adagio helps you then build that structured product, right? And then with your $25 million in available cash, you buy a quarter of that project. Well, how are you going to get the other 75 million? Well, enter Frenchie, enter Toby, enter any number of other people who've also built funds. They now want to find structured product within or without Adagio that they can invest in. Here's another fund. And because we all have fund of funds, we can go in and buy a share of that structured product based on what Ben and you have created. And so that's what puts you in the blue box on the far left, as well as the orange box on the right. I hope that makes sense. I hope I answered your question. Again, the whole thing is subject to that blue box project being a, shall I say, a qualified project by Adagio underwriting standards. And of course, as Ben is teaching us, he's teaching us how to create or work with very rigorous risk-adjusted underwriting standards. And that's so that you're going to make, the whole name of the game is make money when times are good, make more money when times are bad, right? So succeed or fail, you're still going to make money at that project. And that's how he helps you create a structured product that's going to work. Any other questions or thoughts before we go on? Great question, Anthony. Thank you for asking that. Frenchie, what's up?
Yes. Good evening, everybody.
Yeah.
Yes, Mark. Previously, you said that we would take advantage of both sides. Can you clarify that for me? Because I know obviously the buy and sell side for Adagio, but how are we taking advantage of that?
Okay, that's a great question. Again, we start by taking advantage of the orange side. I'm going to use the color scheme here just so that I can give you a good point of reference. We start by taking advantage by putting our fund on the orange side. That is our fund. That's your fund that you're setting up, is that orange box. And so you can look at it and say, okay, I'm getting investors in and I'm raising money. Now, how do you get returns for your investors? Well, the first thing we do is that we've talked about doing, of course, is we purchase the safety net from Adagio. He has a number of structured products that are designed to provide generous returns for the various structured products and provide a safety net for your fund so that your fund won't fail. Okay. So that's what I was referring to a little bit earlier when I said, if you took 50 cents of every dollar that your investors gave you, let's say you've raised $10 million. Okay. So you take 5 million of those dollars. Now we're getting into asset allocation here. So you take $5 million of the 10 that you've raised from your investors, and you use that to invest in maybe 3 or 4 different structured products that Adagio has created. Whenever you hear the term structured product used by Ben, either in the book, the course, or in one of his podcasts, and he's talking about structured products, he's really talking about a fund. Okay, so he's created a fund around that particular product, that particular structured investment. So if you want to take that $5 million we were talking about, and you allocated it between 3 or 4 different structured products that Adagio has created, 3 or 4 different funds that Adagio has created, okay? And so because you're a fund of funds, you're able to take that and there's no regulatory limitations. I can buy 3 or 4 different funds from Adagio, right? And so I've now allocated my $5 million. And, you know, so far this year, those who have done that have made about a 50% return on their money. Not so far this year. If you analyzed what they've done so far, actually it was last year, 2002. I'm in 2022. I'm in 2023, unless of course I think I'm in 2003 and then I'm going nuts. But but essentially, they had a 50% return last year. Okay, so if we'd done this last year,
He's funny.
took that $5 million, made a 50% return on $5 million, you'd have a nice return for the entire investor pool of your fund, right? You'd have about a 25% because you'd make $2.5 million on 10 million, which is, 25% return. So I'm working in big general numbers. Obviously you have expenses and obviously there's other things going on, but I'm just trying to give you a concept and throw just enough numbers at the concept to help you understand why you would want to buy some structured products. In fact, personally, and this is just me talking, I would buy those first. I mean, I would not go out and try to endeavor to do my own thing until I'd actually put those safety nets in place, or as Toby called them, airbags. Like putting airbags in a vehicle. And so,
Well, that was my first thought too when you said it.
yeah,
Because anybody who did good last year is in good shape, because last year was a bad year for a lot of funds.
yeah. In fact, this is the beauty of what Ben is offering to do for us. As we look at our history, you can say, I'm Mark here, and this is my first fund, and I haven't raised a dollar, okay? But oh my goodness, I have a track record. What do you mean you have a track record? I can show you going back, to 2007, how well my products have done for my fund. You don't even have to back test it because if I took 50 cents on every dollar, in fact, if I took 100% of every dollar until I put a certain dollar amount into Adagio structured products as safety nets, I can use Adagio's history as my history. And you don't have to have special permission to do that. You already got it. Ben's already given it. So when you're talking about rolling out your fund and they say, well, what kind of track record do you have? You can say, hey, I'll send you a schedule with our track record on it. And you just simply put Adagio's numbers on there with your name on it. Okay. We already have clearance to do that. So we're not swiping anything we shouldn't swipe, because if that's your plan, if you're planning to put in safety net first, then you're using Adagio's historic record as a way of convincing the investors that you're going to continue to maintain that record. Does that make sense?
Excellent.
So yeah, that's a real easy way to tell the world, this is the kind of returns we're getting. And yeah, you're going to have to say in 2022, the collective we made 50% return on our portfolio. One in?
Right. Yeah. Yeah.
So
how quickly can we get that information?
I'm sorry?
How quickly can we get that historical?
It's right there in the book. I'm not sure. Let's see, Ben, I believe it's right there in the book. I'd have to pull up the page that's on. In the first edition of the book, he had the history there. I think it's on page 92. Jody or Toby, correct me if I'm wrong. But it's on one of those pages in the book, and he only went to like 2015, 2017, something like that.
Yeah.
In the new edition, I'm anticipating that he's coming all the way up through 2021 and maybe even part of 2022.
Okay.
So he's got a lot more years on there. Huh?
Yeah, because I haven't read. I got the new one, but I
Okay.
haven't read it yet.
Yeah, I think if you go to, I think it's page 92, somebody correct me if I'm wrong, but if you go to page 92, I believe all that history is right there. The other thing he does on those pages is he compares how well he did when compared to the S&P 500 and how well he did compared to a major real estate investment trust. And so you can see how he compares to those. So it's, and he beats the socks off of both, by the way. So, but those are good numbers you can use in your own presentations to show what you can do. In fact, as I'm talking here and I'm brainstorming a little bit, there's a place in the business plan where they call for prospective financial statements, right? And Ben eschews prospective financial statements. He'll help you do a back test before he'll bless any kind of forecasts. Well, in those quote for prospective financial statements, you can put a history of how well the alternative assets have done by simply putting in there Adagio's history. And yet you're putting your name on it and saying, this is our history. And that's because we're going to put a big chunk of that fund into those structured products before we go jumping off the cliff into our own projects. Okay. So Frenchie, I've answered half of your question so far. Okay. I'm going to now jump to the other half of your question.
Okay.
And that's the blue box. So after you've set up your fund, after you've pulled in investors, after you've set up the safety nets, if that's what you intend to do, assuming you put 5 million out of the 10 million into safety nets, that now leaves you with $5 million, another $5 million to invest in other funds, right? And so this is where, you finding other projects and you creating other projects come along. So I'm going to use a different example just to mix it up a little bit. Let's suppose you go find a company and you see that the assets are way undervalued. This company could be worth 10 times as much as they're asking for it based on the kinds of things that you could do. You feel like you go in and help turn it around. You could put a team together to go in and turn this company around. And so you find a mid-market company that is for sale for $20 million, okay? And you think to yourself, wow, I'd like to take this $5 million that I have in this fund and put it into this company. Because I know that if we were to buy this company for $20 million, I could turn it into a $200 million company in about 12 months, right? I mean, it's that undervalued. And you do find those kind of deals out there. I'll give you an example. Several years ago, this was probably about 15 years ago or so, I had a client approach me. He had what he thought was about an $80 million real estate empire. Okay, he thought he had about $80 million of real estate. And he had leveraged that million that he couldn't leverage it anymore. There just wasn't any more value in those assets. And so I looked at his balance sheet. I looked at the assets. I obviously went out and inspected all of them. I went through and just did a lot of due diligence for about 30 days. And me and my partner on this project came back after about 30 days of due diligence, and we said, oh my goodness, can we do this deal? He was wanting to get a bailout because he figured he'd over leveraged $80 million worth of real estate. Well, when we looked at it and we did our due diligence, we determined that real estate was worth actually about $250 million. So did we want that project? In a heartbeat, because we knew we could not only get him, out of his predicament, but he had a lot more equity and value in there than he thought he did. And so, anyway, the happy ending to that story is that we got him about $200 million worth of bailout money to satisfy his creditors and put him on a track to launch greater growth into his real estate empire. So that's what I'm talking about in terms of finding undervalued assets. So going back to my example, you find a company, they want $20 million for it. Maybe they want out. They're tired, whatever reason. Okay. And you look at the assets, you look at the opportunities, you look at the products and the potential sales, and you're going, oh my goodness, this company should be worth $200 million when it's all said and done. All right. So you take that project and you go to Ben and you say, Ben, this company is going to cost me $20 million. But I think I can turn it into something 10 times bigger. And so I'm going to I have $5 million left in my fund right now. I'm gonna raise another 5 million. But I need some help structuring a fund around this, a structured product around this, that I can then make sure that this is a successful project for my investors. And I'm going to need some other people to throw some money into it as well. Okay, that's the blue box on the left. Okay, so you go out there, you raise another 5 million, you buy half of that blue box for $10 million, and then Jody buys $5 million worth for her fund, and Anthony buys another 5 million with his fund, and you've now bought the company. Okay, and that's how you're on both sides of the transaction. Does that make sense, Frenchie?
Well, when you say both sides, I'm trying to figure it out, get it in my head.
Okay, well, that's what this this picture is all about. It's showing you the both sides, because the orange box is your fund and you're bringing investors into your fund. The blue box is another fund that you and Adagio are creating together, and Adagio is bringing you other monies to go into that fund.
You're talking a fund of funds, right, Mark?
Yep. Uh-huh. Yep,
Okay, now what you just said a key part, and that part that you just said, you said Adagio helps bring you funds to buy into another fund.
Yeah. In other words, you've got your investors that you're bringing into your orange fund. Adagio is going to bring you additional investors for your blue fund or your blue project.
Yeah. No, that part I understand. I get
Okay.
that part. Yeah.
That's all I was trying to say. That's all I was trying to say is that there's other investor dollars that will come into your fund through the blue box. And maybe I should put a big arrow from the blue box to the orange box.
No, because you just said a key point, and that's what the funds that you bring in, and this is just for clarification, so that way I can understand it myself, and if I have to say and interpret it or teach it to someone else, I can get the full understanding as well. But now, because you made a key point, and I just want to point it out. When you say Adagio is going to help us bring in funds, now those funds that Adagio is raising, so say Jody brought in funds, I had my funds, and Anthony had his funds. Now our fund, those particular funds that Adagio brings up, those I have nothing. Those are separate funds that for me, they're not my funds, so it has nothing to do with me. But yet we're all investing into the same structured product.
Yes.
Okay,
Yep.
so actually those funds I have nothing to do with.
Well, you only have something to do with it to the degree that A, you bring the project to Adagio and they approve it, right?
Okay.
B, you then are able to buy into that project. Since it was yours, obviously you have the first right of refusal to buy as much of that product as you want or are able to buy, right? And so you're putting your investor dollars into that project. But to the extent that you're also using that to raise additional monies,
Okay.
then Adagio will help structure this so that it's attractive to other people, and other people will put money into your fund through that project.
Okay, excellent. Then now I got it. Now
Okay.
that's okay. Now I understand. In other words, if it's a product that I brought in, that
Mhm.
Adagio underwrote it and it passed
Mhm.
their underwriting process,
Mhm.
okay, then that's
Yeah.
my project. And then, so they will be willing to raise the other funds or bring in the other capital to
Yeah.
invest into that product. Now,
Yeah.
if it's their product, if it's their structured product or alternative asset, then that's different. Or is
Yeah,
it, or
and
is
you
it
could
still
still
treated,
buy
or is it
into it
still
if he
treated the
invites you
same?
to.
Right, right. Okay, so it's still treated the same,
Mhm.
but the fact that is, if it's my product, if it's my project or my structured product, then I'm treating it, how do if I'm saying that correctly? It's still, well, it's my product, so I'm bringing in a product that Adagio will help me raise capital for. And I
Right,
know, and I
right.
know I'm repeating myself, but I'm saying it so
Yeah.
I can clarify
And
it in
so
my,
yeah, exactly. And the one caveat I want to create out of all this is that terms and conditions do apply. Okay, so not everybody just bringing a project to Adagio are going to be successful in making that project succeed, because it's going to have to pass their rigorous, and I want to emphasize the word rigorous, muster, because we're all about managing risk, right? And so it's going to have to, you're going to have to apply those risk management thresholds for it to get the green light. But if you do prove that you can get the green light because of those risk management thresholds as an asset manager, then now you're getting money from Adagio to invest in your project.
right.
Or I should say, money through Adagio to invest in your project. I'm not saying that Ben is investing his own money. Maybe he will, maybe he won't, don't know. But he'll act as an investment bank to bring you other investor capital, namely from other funds, other asset managers, to put that into your project. And so you now are acting as the investment bank of sorts, because you're attracting other people's fund money to go into your project and your fund, essentially.
Okay.
So I hope that's as clear as mud. That's why I put these two arrows on this page, you know, where I put up there in the upper right, your fund goes here, and I meant that to go into the orange box. And then I put your fund may, or I should have might say might go here, because if you've got on the buy side of the Adagio dynamic, not just the sell side of the Adagio dynamic. Does that make sense?
Yes.
Welcome, Jody.
Hello,
Okay.
sorry I was late.
Oh, you're fine. You're fine. Wow, even blowing this thing up as big as I have, this is going to be virtually unreadable. So basically, and I put this up here to show you Ben's credentials.
Yeah. Will you make these slides available to us, or?
Yes, that's what I'll do, is I'll put the slide presentation into the community along with the archived video, so that you can look at the slide presentation and video apart from each other. But the significance of this is that, you know, we talk about Ben being Mr. Compliant or Mr. Compliance. And this is from the FINRA website. And I'm probably describing this incorrectly, but this is Adagio's FINRA filing. This is what FINRA has on file for Adagio, and that Adagio is listed or registered or filed, or however you want to say it, with the FINRA organization, and is compliant with what they do with their filings and who they are and how they manage things with FINRA and SEC regulations. Another thing that Ben has put down here along the bottom, which I think is really cool, is he's giving you a year-by-year overview or timeline of the evolution of Adagio. So he shows the founding of Adagio in 2005, all the way up through the financial services, the entities, and the different funds and things that Adagio has set up. So this is a good history. In my PPM, for example, I am, and I recommend that you guys all do this as well. In fact, that's why I'm going to make my PPM available to the community. But in my PPM, I am featuring Adagio as providing those safety nets for my fund investors. And so you're going to be talking about Ben and his qualifications, his compliance as a investment bank and as a promoter of these safety net type alternative assets. And so they're going to want to know a little bit more about Adagio. Well, this is a great slide to put into the PPM that goes through Adagio's background so that they can go out and do their due diligence and say, okay, yeah, Adagio can provide the safety net for this new fund because of their compliance. So take a look at that when it hits the community, and we can talk about it on other Tuesday nights if you have any questions about this, but just read it in detail. Take 5 or 10 minutes to just really look it over and see that you understand what Ben is doing here.
And I think we have don't we still have a date to go through the your PPM? I think we were supposed to.
Yeah, we do. I've just got to finish it here.
Okay. No, I remembered it. I didn't know if it took
No.
place or not.
No, hasn't yet. I've just been taking longer to complete it than I thought, but this is good for all of us because when it comes out, it's going to be solid. I was just talking to Dwayne about this. We were talking about, and I hate to say this, especially on something recorded like this, but some people just simply need to do these funds, and they just can't afford or don't have the $50,000, $100,000, $200,000 it would take to get these funds up and going. And so what I'm trying to do is create an alternative that allows them to be compliant, allows them to be legal in that sense, and allows them to have the quality of a very expensive attorney without having to pay one.
Right.
And that's what I'm hoping to accomplish with my legal docs when
Right.
all is said and done.
Yeah, they're telling us that all the time, that the
Yep.
more you spend educating yourself on the document, the less you spend on the back end.
That's right. That's right. And I've spent a lot of time on these documents over the last 20 years. And so I'm just reinvesting a lot more time to use them for funds. And in so doing, I'm hoping to save a lot of money for a lot of people.
I don't know if you heard or not, but I've been hearing that a lot of people have been having, I've been hearing them say that one of the toughest parts about managing their fund is staying in compliance. I'm not sure if you heard that or not,
Yep.
but I've been hearing that lately.
Yep. And that's one of the blessings of having Ben working with us, is because he's going to make sure we don't step outside of those guardrails. That's the name of the game, is to stay in compliance. And one of the things that I hope that Carl will do for us as a member of our community, he's an SEC securities attorney, I should say, not an SEC. I don't know if he's got experience with the SEC. I think he does, but anyway, whether he does or doesn't, he's a securities attorney. And I'm hoping that part of the value that Ben and Carl offer us is to be able to make sure we don't step outside of those lines. You color outside the lines and the SEC will jump at the chance to come get you.
Well, I think, Mark, I'm going to interject here. I feel pretty confident, Sam, that Ben would. I mean, even in his last book, remember he had talked with that group. Their name is escaping me, Woodbridge.
Yeah, Woodbridge, I believe it is, yes.
And, you know, met with those guys and could have kept him out of jail.
Yeah, yeah,
So I think he's pretty passionate about that and would not want
Yeah.
any of us to get in trouble. Plus, it would reflect on him.
yes, absolutely. And so
But-
that's why I'm confident.
Yeah, well, and Ben's
that-
a SEC expert. I mean,
Mhm.
I think that's how he and Stefan actually met, because Ben
Mhm.
was called
In
into
fact, I think
some-
they met on that Woodbridge project, didn't they?
I'm not sure about that, but I know
Okay.
that he was called in as an expert,
Mhm,
an SEC expert of something. I mean, he's pretty much known for that, so
mhm.
I feel pretty confident. He'll
Yeah,
keep us out
yeah.
of trouble.
Yep.
God knows I need that.
Yeah. Well, I know that a lot of people with good intentions who are not fundamentally crooks get in trouble with the SEC all the time. But fortunately, like you're saying, Jody, those kind of people, if they find themselves sideways with the SEC and they have somebody like Ben and Carl come in and help them out, my guess is that 99% of the time you can get straightened back out with the SEC without having to incur, huge fines or worse, criminal charges or anything like that. But
Right,
you just got to take it serious. And
Right.
that's the key, I think, that Ben is trying to say. He says, when he says compliant, everywhere he says compliant in the book, don't just pass over that compliant word and go, oh, yeah, compliant, whatever. No, when he says compliant, he means, and you're taking this serious, right? And so anytime you read that word, anytime you hear that word, that's for you. It's for you to sit up and take notice that what you're doing must be within the rules.
Yeah. I was gonna ask Jody, what was she trying to say? You're not a troublemaker, are you?
just seems to find me. I don't know how.
So anyway, I'm going to stop sharing my screen here. And we'll wrap this up. If anybody has any questions or comments, I'm going to look at the chat here and just see what people said. Can Ben assist us in getting something RIA or broker dealers as distribution partners and how to set that relationship? I don't get that that's what he's looking to do for us.
Well, and I can attest that I just got a message. I was asking him about, because I got in touch with this group. That's what I was saying on there. They have this database that they go out and scour, all the RIAs. And they do it, like they update it every week, because RIAs, I guess they transfer here and there and everywhere all the time. And so it's hard to keep that data, unless you're going in and pulling it from the SEC every week or whatever. So this group, I don't even know how I found them, but they provide you with the data. It's only $12,000 a year.
Yeah.
And I asked Ben about it if he'd ever used it for a different purpose. I wasn't going, it was for the CPA stuff. Mark is why I asked him if he'd ever used a service like that. And I can hear him in his brain, dumbass, it's public knowledge. Why would you pay for it? I'm hearing him say that, but not that he did. He was very nice. But he was like, Jody, you don't even want to broach that until you have 500 million assets under management.
Yeah.
So that's
So
straight
you
from
might,
him.
yeah, you might have RIAs and broker dealers in your personal network that you can bring into your fund, and that's great. Ben's more in assisting his job as your technical guru. He wants to be the technical guru for your fund. So this is Anthony talking. So Anthony, he wants to be your technical guru, which means he knows all the ins and outs of the investments, the structured product that he's suggesting that you put into your fund. Okay, through, and so you're investing in structured products that Adagio has created into your fund. And now you go out and find your investors, and that's your part. You need to either find the investors or bring a person onto your team who acts as the marketing and salesperson to go find.
I think, are we losing him? Because he was breaking up.
I didn't know if it was him or me.
Yeah, I know. That's why I was asking. I wasn't sure either. So it must be him. Yeah. I'm not sure. Can you hear us, Mark? Because you're breaking up.
Or they might just be have something to invest in.
There he's back.
Okay.
He's back.
You were
Was I
gone
for a while?
Yeah, you were.
Yeah. Well,
Oh dear.
yeah, you're in and out sometimes on the whole presentation, but this time was pretty bad. But
Okay, I apologize. I've got some bad internet connection tonight. So let me see if I can recap what I was saying for the last 90 seconds. And that is Ben doesn't assist on the marketing side. The marketing side being you bringing in investor dollars. That's marketing. He wants to be the technical guru. In other words, he's creating your products for you to get the kind of returns you want to get. So it makes it easier for you to go out and get investors. And so I'm assuming everybody heard Jody's answer to this question, and that's a good answer as well. And so, go out and market it, attract all the people you can into it from your asset base, your network, your client network, and that kind of thing. And those are going to be the people you're marketing this to. Or go get somebody to join you and be your partner who will do your marketing, and you can manage the fund. That's a way to do it too.
okay. But you said, but he will assist in the marketing stuff. You said he will or will not?
He will not.
Oh, okay.
That's your job.
All right.
So either you've got to find somebody, and I recommend there's people in the community. There are people in the community that want to market funds as opposed to manage the day-to-day details of the fund, right? Remember the 3 hats that I've talked about in the past.
Mhm.
So you've got the technical hat, which is the product expert. That's Ben. Then there's the fund manager. That's the detail-oriented person to just track how everything's done. And then there's the marketing person. Now you can wear all those hats, or you can have 3 different or more than 3 different people wearing those different hats. Okay, it's however you want to structure your team. But Ben, specifically to answer Anthony's question, focuses on the technical product details. He doesn't focus on marketing, network building, going out and finding RIAs, that kind of thing.
Mark, is he still doing, because I know at one time he was talking about sunsetting that whole program.
Oh,
You know
yeah,
what I'm talking about?
yeah.
But is he still doing the other one that we had talked about where you can go in and be an affiliate? The affiliate marketing.
Oh,
Because
the
he
affiliate
will help
marketing?
with that. And you can use his book.
Yeah, I'm not sure. I'm assuming so.
I am too,
the
but-
financial associate, that was the financial
Yes.
associate program. That's I'll have to go into the classroom and see if that's still there.
Yeah.
The
Because that's
marketing,
another marketing way that someone could,
yes.
that is one way that, and Ben has a whole document about marketing.
Yeah, there's a whole document. We made that available in the community several months ago. And you can go in and find that document. There's a link in that document that lets you go in and sign up as an affiliate. And then as a financial associate, that's what they call these affiliates, you can now effectively market Adagio. And as people buy the book, as people buy the masterclass, as people buy the other materials, as people work with Ben, say you find somebody and they've got, millions of dollars and they go straight to Ben and work, Ben will pay commissions and things like that to you. And that certainly helps with some of the cost of setting things up if that's something that you want to do. This is particularly good if you've got a really good network to work with. If you've got a lot of people who, if you go back and you look at that slide that I did, I probably don't know if I want to share my screen again, but you remember I showed you all of those different professional groups. If you've got a lot of people and access to a lot of people in those kind of professional groups, then marketing Adagio while building your fund may be a really good, lucrative alternative for you. And so, you know, consider that as a possibility. And that's all that
just thought I'd
material
throw
is
that out
there.
there.
And yeah, thank you. That's a good idea. All that material is in the community. You might have to go look for it because it's a couple of months old, but if you go back a few months, you'll find, I think I put up a post in the community that said how to make money while setting up your fund or something like that.
Yeah.
And
Might
so
have
if you
been
go,
like late summer, early fall last year.
yeah, it was probably mid to late summer. But it was how to make money while setting up your own fund. And it was all about getting involved in the financial associate program and promoting Adagio's educational materials.
Now, is that different than the program that he mentioned inside the book towards the end of the book?
Yes, it is different. The other program inside the book is an advanced training program, which he's going to rework also, where he says the focus is going to be on FINRA licensing, to the extent that you might want to take that program to become FINRA Series 65 licensed.
Right.
I think he has a deal with one of the educating groups now.
Yeah.
Okay.
So he's revamping that. But, you know, if we end up selling that program, he would probably pay us a commission. So, Jody,
Okay.
your question is very appropriate, you know, in terms of, is he still doing that? I'm assuming he is, but I don't know. Maybe something's changed.
We'll have to ask.
Yeah. Yeah. Okay. Frenchie,
Any
did you have
idea?
another question?
Any idea when he's going to finish or finish revamping that?
No, he hasn't told us anything about that. Just that he was planning to do it. I'm assuming, and again, with all that implies that he's still selling the other course, the other advanced course. But I don't know. I don't know for sure.
Okay, because the 65 is on my list to do.
Mm-hmm.
And I know how thorough he is.
Yep.
And I know that would definitely have me prepared for the 65 exam. So I was considering maybe trying to run through that first, as opposed to, I mean, I have a couple of options. I mean,
What he recommends, this is where you get into your 506A versus 506C.
right. Yeah.
He's recommending that rather than go into the 65 first, that you do a 506A, which doesn't require a 65. And if you do the 506A and it doesn't require 65, you can get into this, you can get your fund up and going, you can do all that you need to do, and then get your 65 and set up another fund, set up a C at that point, and have a second fund. But he's trying to help you remove the obstacles that are getting in people's way of just getting set up and getting things going. And so I think he would rather see you set up a 506A fund of funds and work this Adagio program, because the Adagio Institute offers the educational program. So if you're simply replicating the Adagio program, educational program, you can legally and compliantly set up and run a 506A without being a 65, FINRA 65. Because they have given educators an exemption to the Series 65 licensing requirements if they do a 506A.
Yeah, the only thing for me is that I have to take in consideration is the amount of time. I mean, because there you would have to have an investment club,
Mhm,
and you
Yeah.
have to manage, you have to not only manage the fund, but you have to manage the club too.
mhm.
So, and that requires an extra time when you're trying to do, you're wearing so many hats.
Yeah. Yeah, it's a little bit of extra time, yes. But apparently he feels that that's worth it compared to holding up a fund until you've completed your 65.
Mhm,
And so that's why he gives that recommendation.
sure. Yeah,
He
no,
apparently,
understood. Yeah, very well taken. I understand what he's
Yeah.
getting at, and it makes absolute sense.
yeah, but you're free to do however you want to, but
Yeah,
that's
yeah.
what he's trying to do to help you step past that hurdle.
Sure, absolutely.
Let's see. Anthony had a question. He said, when would we have the legal docs done? I mentioned it on another call. And Anthony, it's slowly but surely getting closer and closer to the end zone. It's one of those agonizing, painfully agonizing things where, I cut the distance in half, then I cut it in half again, then I cut it in half again, then I cut it in half again, and I'm still halving the distance. And what that means is, I'll infinitely never get there.
Hey, Mark, he's actually
Yeah.
asking about your done for you fund doc service.
That's what I'm talking. Oh, the service itself. Oh,
Yeah,
that's probably gonna be later on. Right now, I'm trying to get the documents done that will do two things. Number one, it'll get Jody, our Omega fund launched. That's the first thing. Second thing is I want the docs to be available to this community so that you can beta test them. I want people to not just, look at them as, oh, this is the Omega fund documents, nice sample, but I want them to then decide, I want to use these documents and, strike Omega from everything and put their name on it. And then, use them.
and make
And-
suggestions, right, Mark? Like,
and make suggestions and all that kind of stuff. So you guys are my beta testers. And then once I've gotten enough feedback from everybody on these documents and we've made the necessary changes and whatnot, then I'll consider, that's what I'm going to put, consider creating a done for you fund in a box kind of product that we can put out there as a part of the educational component of the 506A. Maybe it's the Adagio 506 or the Adagio Institute, or
you're going
maybe
after
it'll-
Bridger, huh?
yes, absolutely.
I was thinking the same thing.
Absolutely. It's funny because Ben told us about how he invited Bridger to come work with Ben. And
Oh, he did. Okay.
oh yeah, they know each other. And Bridger was just kind of, no, I don't think so. And so, Ben believes that, and I shouldn't say this publicly, but Ben believes that Bridger's given to hyperbole and is selling the idea, not so much, the real thing. And so what I'm trying to do is I'm trying to come up with a kind of a halfway point between Bridger and Ben, and then offer that as a solution. But at the same time, make sure that it doesn't get, it doesn't get people into trouble.
Mhm.
Because when you sell a done for you package, there's a lot less thought that goes into it. And I want people to put the thought and effort into it that they would otherwise put into it if they were building it from scratch. I'm just trying to save them the time and effort that it would take to, do the paralegal, cut and paste job.
Right.
So
It's funny you said that, because when, sometimes I go back and forth between the two groups. And I know, and what you're saying is very specific, because I mentioned the 506A in their group, and he really didn't go to that side. He was staying in the middle lane. He was saying
Yeah, I
that
think-
506A was okay, but he was more down the middle road. And
is he more of a 506B guy?
Yeah,
I
yeah,
kind of thought so.
right, yeah,
And see, 506B is where people get into more trouble than anywhere else.
well,
Because what's happening is you're trying to work with the non-accredited exception, and you find yourself then limiting your ability to
is the
get
B
the
the
size of,
non-accredited?
huh?
The B is the non-accredited?
B is both. It's a hybrid between accredited and non-accredited. What they say is you can have up to, correct me if I'm wrong, 100 non-accrediteds now.
Yeah, they did change it, yeah.
Yeah, and then all the rest have to be accredited. Well, what that means is they've got a rather relaxed method for validating whether you're accredited or not. And because it's relaxed, a lot of people start out passing themselves off as accredited when they're really non-accredited.
Well, he was pointing that out, and I think he's
Yeah.
both B and C. He was pointing that out because he was giving an example of his fund where he used a third party. He doesn't do the necessary.
That's why, that's what you absolutely must do. I'm not saying by law you have to do this, but boy, if you don't want to get in trouble,
Exactly.
the 506C, you're going to have to, because you've got to demonstrate to the SEC that you've been diligent enough to validate their representations that they're accredited. And so there's a set of procedures that you got to go through. And so, yeah, you want to use a third party because they're certified, if you will, in terms of validating. And if they validate someone as being accredited and they're not, then it's on them, not us. And so, yeah.
Because I mean, you have the two scenarios where the one where you can have your accountant write in a letter and say you're accredited.
Mm-hmm.
And then you have the third party who goes in and verifies that they are accredited.
Sure.
They are compliant.
But if you're doing any less than that, if you're basically just having them under a 506B, they're basically checking a box and says, yep, I'm accredited, and they check a couple other boxes to say, yep, I've got over $1 million in net worth, or I'm making more than $300,000 a year, or, checking into the other boxes, but it's a self assessment. It's not validated by a third party.
Yeah,
and
I can tell you he doesn't go that route. He goes the 506C route. Yeah.
Okay, so if he's going the 506C route, then that's good. But that's where, people doing 506B, they get themselves into trouble, because then they end up doing something like stacking. They'll think, oh, I can work around this. There's a loophole. I'll put a 506C over here for all the accrediteds, and I'll do the 506B for my unaccrediteds. And now all of a sudden they get accused of stacking, and they're gnat's eyelash away from jail.
Now, when you say stacking, what does that mean?
If you do two different types of funds, let's say you do a 506B and a 506C.
Right, they're separate.
And they're separate, but you're treating them the same. You're investing in the same investments. You got the same management team. Your investors are going in to see if they're accredited, and B, if they're unaccredited. What'll happen is the SEC will come in and go, we're going to treat this as though it was all one fund. They call it stacking, and they'll treat it as though it's all one fund. And you can bet that they'll treat it as the one single fund that will get you into the most trouble. Okay. They'll say this is a B if it's going to look like you're going to violate the B requirements of limiting it to 100 non-accrediteds. And they'll call it a C if they want to make it a C, because you're going to get penalized higher for having an unaccredited into a C. So that's what I'm saying. They're going to say you're treating this more like a B, or you're treating it more like a C. And believe me, they're going to pick the one that gets you the most fines and in the most trouble. Okay. So that's where, the risk of stacking is very, very dangerous. So, it might be good to make sure that you don't have a B and a C open at the same time, or for that matter, you don't have an A and a B and a C opened at the same time. Because, if they came in and accused you of stacking, then you're going to be trying to defend yourself.
Or at least have them managed separately or staffed separately.
Yeah, you got to have them probably, treat them completely arm's length with different management teams and different investment structures and the whole thing.
Point. Yeah.
Okay, good questions.
I opened up the second edition of his book. I don't have the book. I had the PDF.
Mhm.
But I don't know if this matches the same as when you say page 95.
Mhm.
But were you talking about, there's a chart there that says the risk-adjusted performance characteristics of Adagio's ABL strategy? Was that it?
Yeah, does it have a bunch of numbers on the page?
Yeah, absolutely.
Okay, so that probably is the risk adjusted performance measurements that show the history of Adagio there. It's got year up in the right hand corner. You should see something like 2007 through a fairly recent year. It's in a square box in the upper right corner, my guess is.
Yeah, but I'm looking at this and it's saying 2015, so maybe this isn't the
Maybe
new.
it hasn't been updated. We'll have to see if Ben can update that if it hasn't been.
Yeah,
Because we'd want to get more recent years besides 2015. I'd like to be able to go from 2022 back to 2007.
yeah. Well, 2022 is the important one because that's when the S&P and everything did perform poorly.
Yeah,
And
exactly.
the fund did well. That's a big.
That's really the financials that I want to put in my PPM, the business plan portion of my PPM.
Correct. Absolutely.
And so let's see. Yeah, if that's what that says. And then of course, next to the years, you see ABL, and then underneath that ABL column are all kinds of returns. So the interest rate they got in year 2005, the interest rate they got in 2006, 2007, and so forth. That's the history that we're talking about.
Okay, yeah, this is the second edition, so it only goes up to 215. So
okay. The rest of those numbers are how to calculate risk-adjusted performance. Okay, and I've created spreadsheets that duplicate that now. So I basically can show you how that's done. Now I did a video. Jody, when did we do that video? I mean, that was probably, I don't know, back in June, July, 6 months ago at least, where I did a video and we walked through all of those risk-adjusted performance measures. And we walked through the calculations and talked about them.
Is this the one where you said you and him were going at it with the numbers?
Yeah. We had a subsequent meeting where actually I did a similar comparison between ABL and the life insurance industry against their mutual policy returns. And I did a similar spreadsheet for us to look at that. And I made the mistake of sending it to Ben. I'm laughing when I made the mistake. I was happy to send it to Ben. I'm actually glad I sent it to Ben. He said he wasn't going to open it up. He goes, I'll just get caught up in the numbers. I'm not going to open this up. And the next thing you know, he's got it open and he's looking at the numbers.
Yeah.
The good news is, and this is what I really appreciated about Ben, was he was able to validate a lot of my effort there.
Great.
There were a couple of things that I, could use tweaking, but by and large, I came away from that discussion feeling like I'd done a pretty good job on it. But that's what he said. I can't get into this. He goes, I'm in it.
Well, I got rid of calculus and all that back in college. I'm not sure if I want to venture back down that road again.
Well, it takes a unique kind of geek to get into spreadsheets.
See, well, that's the thing, because I'm that type of guy too. But I know when I get in it, it's hard for me to come out. You know what I mean? So
I mean, I tell people, and this is true, this is a true story. Ben and I have compared some personal notes, and we both agree that we probably are both somewhere on the autism spectrum, somewhat. And because for a lot of personal reasons, we've compared some notes, and I've actually been diagnosed as being on the autism spectrum.
Oh, you have?
And formally diagnosed, I guess you could call it.
Mm-hmm.
But it's interesting because one of my tendencies is to be allured by spreadsheets. I love looking at spreadsheets, and
I do
I'm
too. Especially when I
I'm
could find something
fascinated
wrong.
by them. Yeah. And so, my wife, whenever I look at a business opportunity and I'm all excited about it, she goes, "You've been looking at the spreadsheets again, haven't you?" And I'm going, yeah. And so,
I get that from my family because I'm a detailed oriented guy. Because when you're an architecture, you have to get everything very detailed,
oh yeah, yeah,
and you can't miss a thing.
yeah,
And so my family gets on me all the time because they know when they come to me, they know that I'm going to put them through the grill
yeah,
because I'm going to ask the questions, and
yeah,
I want details. Just don't come to me with a half story. Give me all the details.
yeah. So yeah, when I redesigned his spreadsheet there, for me, it was just playing. I was like a kid in a sandbox, and I was just sitting there playing with those numbers and studying those numbers. I went out onto Google and Googled every one of those ratios and every one of those numbers to read the description and understand what it's saying and what it means and how it's calculated, and and the whole thing. So I'm one of these guys. I don't count sheep at night. I actually calculate compounding interest.
I'd say to my son, I tell him how lucky he is, because I said, listen, when I was in school, we didn't have the internet and the phone and all that. When I had to do research, if the library on campus didn't have it, I had to go off campus. I had to
Yep.
travel over from New Jersey to New York to the library there and search through there until you find it. And I end up finding things in like a little bookstore somewhere on the corner that's just, we're out of nowhere. So I said, you guys have it real good.
Yeah. So, all right. Any other stories or a good joke or questions before we call it a night?
No, great presentation. I'm sorry I missed the beginning part, but I'll read.
Yeah, me too, Mark.
Well, you'll get to see it in the archive. I'm going to put it up on the site, and then I also will put the presentation up separately so you can get a closer look at the slides.
Is
and-
Toby all right? Toby's been pretty quiet. Is he okay?
He has been quiet tonight. Toby, you want to say hi to the world before we hang up?
Hey,
Hey, all, just been multitasking.
Oh, okay.
But I'm
Just
gonna-
checking on you. Sorry.
Hey, Mark.
Thanks, Frenchie.
oh, sorry, Toby.
Good.
Any thoughts on what we want to do on lab on Tuesday?
Typically, I don't do any preparation for Tuesday night lab other than to just come and answer questions.
I thought we
Our-
might post something.
If
the
you want to post
community.
something, or if you want to put something up specifically to generate some discussion, feel free.
Okay.
You can do it any way you want. I
When are we
will
go-
have to. I was just
When are
gonna
we
say, I
gonna
left-
have our schools of thought, what is it that been his more school of thought, economic?
Oh, the Austrian School of Economics
Yeah.
versus Chicago or
Yeah,
Keynesian or
Yeah.
something like that.
we need to
Sure,
do that.
We can have a debate sometime that that debates the different economic schools of thought.
I would actually personally enjoy that.
I see.
Okay.
Now I know where the trouble comes from. Now, see.
Yeah. I mean, I would announce it a couple weeks early just so that people can kind of gather their thoughts, get their ideas clear, and then
Maybe we'll ask Ben, because he could be what's his?
the moderator.
Moderator, yeah.
No, what's
What-
his lean? Where
His
does he-
leaning, oh, he's definitely Austrian
Austrian?
school. He's
So
Austrian
maybe
school.
we could, find people that want to go up against. Ben could be the Austrian school representative.
Okay. Yeah.
Will we find any brave people to go up against Ben?
Find any Keynesians in the group? I don't think so.
Yeah, that would be very interesting. Yeah. Wow.
Yeah. Funny, I don't see this community attracting any socialists. I just don't see this group attracting any socialists. I would say that, the most liberal thinkers in this group from an economic standpoint are going to be Chicago School, and that's pretty conservative. you know.
I personally would like to learn and know what all those differences are, because I honestly don't.
Well, basically, in my way of processing it, you know, putting labels on things, you know, we shouldn't put labels on people and things, but we do, and we have to in some respects. But it has to do with the amount of government involvement in the economy.
Right.
Okay, so the Austrian school is on one extreme. Okay, so I admit it, I'm an extremist. Okay, I believe fundamentally governments should not be involved in any aspect of the economy in the most purest sense. Free market reigns, laissez-faire management. Okay, the less government, the better. But Austrians will go so far as to argue for no government involvement in the economy. Okay, now as you move off of that extreme, from let's put them on the far right. Okay, and then we start moving back toward the left. Actually, my image is, so as we start moving back toward the left, there we go. It's backwards. As we move back toward the left, you know, you're going to quickly bump into the Chicago school. This Chicago school is very conservative, and they agree with the Austrian school to a point. Okay, they agree that the less government intervention in the economy is better, but they are also prone to say that we need some government involvement in the economy. So that's why they're a little left of the Austrian school. And then as you go into the other schools of economics, in terms of, and a school is nothing more than a philosophy. You know, that's why they call them schools, but it's a philosophy of economics, where they just have increasing philosophies that believe in increasing amounts of government involvement in the economy. Okay, until you get to John Maynard Keynes, who's just flat out socialist. Now, Keynes was the what was he, the economic advisor under FDR, I think it was. I don't remember where his claim to fame was, something like that. And of course, they were very liberal in their politics, but they were also very liberal in their economics, meaning that they were saying we have to have lots of government involvement in the economy. Okay, and so today's financial purveyors of, or government purveyors of involvement in economy and finance, including the Fed and, you know, our banking structure, they're all very much Keynesian. They're very socialist in their thinking, you know, and so you might have Republican socialists and Democrat socialists, but they're all socialists because they all believe that you've got to have this huge amount of government involvement overseeing the economy. And they, of course, have their reasons for it, and they have their explanations for it and why it's important, and yada, yada, yada. And that's probably where we'll agree to disagree. Because, you know, there are those.
You could pretty much answer that question, why? You know why.
Yeah. But, you know, there are free market ways to handle the problems that they think the government has to step in and handle. You know, and it's amazing when you look at most economic textbooks today, you know, at the high school and college level, and they talk about the economy and the different sectors of the economy in those textbooks. Government sector is right there, portraying a huge role in the economy. And so they're teaching kids right off the bat that government has to play a big role in the economy. And
well, that's right on the borderline, though. You become getting pretty close to autocratic at that point.
Yes, that's what I'm saying. The more you move to the left, the more autocratic you get. So it's not about left or right in terms of liberal or conservative, although to some degree it might be. But to me, the left and the right has more to do with the autocratic nature of the left and the free nature of the right. And so it's all about the quantity of government involvement. And so the more you move left toward Keynesian, the Keynesian school, this, you know, just to the left of John Maynard Keynes now are your central planners, right? The central planners of the communist government. That's the only thing that's to the left of John Maynard Keynes, right? He's socialist all the way. And so you have those two extremes. You got von Mises way over there on the right, and you've got John Maynard Keynes way over there on the left. And it's really a spectrum of how much government is to be involved in the economy. So that's my take on it.
Yeah.
Okay, so we don't need a debate.
Done.
I mean, I'm probably oversimplifying it, but that's
No,
kinda
no,
how
you
I-
weren't. No, you weren't. No, I think you're right on point. No, you're right. I mean, it's been a long time since I've had that discussion or talked about it, but yeah, I think you're right on point. I mean, you bring me back to to remind me about how the Fed was established. That's how.
I thought you were going to tell me I was taking you back to a very uncomfortable place in economics 101. That was a painful time in life.
No, actually, I liked economics 1 and 2. I loved it. Actually,
I did too. I enjoyed econ. In fact, I almost became an econ major.
Yeah, I wouldn't go that far, but
Yeah. Well, that's why I didn't. I mean, I liked it enough to think about it, but I really wanted something more practical in my business career, and so I stuck with accounting.
I think we should be honest with you. I think we should have had more in school. I know, and well, I mean, you're taking me back now. In high school, when I was going to school, my father had his own business, so I wanted to have my own business. So when you meet with the counselors, they ask you what you want to do. I mean, well, I'm in high school. How do I know what I want to do? You know what I mean? So I said, well, I want to own my own business. I said, okay. They said, okay. So they put me on, and they had 2 tracks. They had the college track, and I think they had like the vocational business track. So in my senior year, I guess they asked me again, and they said, you want to go to college? And I said, yeah, I want to go to college. And they said, oh, well, we didn't, then you need to be on this track then. I was like, okay.
Yeah.
Then they tried to shove all these classes to me before I graduated, so I'll be ready. And I was like, wow, okay. So then they tried to give me, what did they try to give me? Physics, economics, and all that kind of stuff. They tried to pile into me before I graduated. And I was like, wow, well, I should have been getting that all the time. Why would you think that I wouldn't need that, even though I'm starting my own business? That didn't make any sense to me. It didn't make any sense. But I'm young. Nobody knows. It is what it is. But
So if you run, go ahead. Sorry.
No, go ahead.
I was just going to say, now, if you really want to laugh, I got 2 confessions. My freshman year in college, I took my first accounting class and I failed it. And so, I mean, I literally, I failed it so bad I had to drop out.
Wow.
And so that's coming from a guy who's been an
I was
accountant
going
for
to say,
40
you're
years.
an accountant.
Yeah.
How did that happen?
And
But-
the reason why I failed it is the second confession, and that was because I was a music and dance major.
What?
Yep.
No
Wow.
way.
Yep.
What kind of dance?
I was going to be the 21st century version of Fred Astaire or Gene Kelly.
Oh, okay.
I was a song and dance man.
You did tap dancing when you were younger?
I did ballroom, variations in ballroom.
Okay.
And
Nice.
so I was a ballroom dancer. I was actually on the college ballroom dance team. I was in the college symphony. I danced probably 4 to 6 hours a day. I was in a dance band where I was lead singer.
Okay.
It was a college band. So I was going to be a performer. I had done stage. I had done a lot of dance, a lot of stage.
Fantastic. Mhm.
And
I would have
so,
never.
I know, right?
ever.
Never guessed that. Never.
yep.
No
Well, they
instruments?
had us convinced that we were going to spend our lives living under a park bench somewhere. And I said, I can't raise my family that way. And so I changed, later on, changed to accounting after I flunked out of my first class.
Oh, man, they made you give up your love?
Well, I don't want to blame it on them, but I do wish, this is gonna be great for the recording.
Yeah, no, right?
I do wish somebody had taken me, put their arm around my shoulder and said, kid, follow your dream. I'm going to show you how you can make it. You're not going to live under a park bench. I guarantee it.
Exactly.
But if you'll follow your dream, we'll figure out a way to make it. And if somebody had done that, I just might have had a different career.
Wow.
Of course, the Navy wanted me really bad a couple of years later. They offered me a flying billet.
Oh, boy.
So, I mean, I would have had a chance to, be Top Gun with Tom Cruise. But I turned
There you
that one
go.
down. I turned that one down too.
Wow.
Not because of the money, just other reasons.
Yeah, I think it would be terrifying.
Well, no, I was excited about the idea of flying. But at that point in time, my wife had a large influence on my career choice, and she didn't want me doing it, and so I didn't
Yeah.
do it.
Oh, you got married young.
I did. I got married very young.
Okay. Yeah.
That's why I have 12 kids.
You said 12. You said 12.
I do. I have 12
You have
kids.
12
I have
kids?
20. I have 12 kids, 20 grandkids so far.
Oh,
I'll
my
probably end up
goodness.
with about 20 more before it's
Oh
all
my
said and done.
gosh. I didn't know you had
Wow.
20 grandkids.
Yeah.
That is great. Good for
Yeah.
you.
So yeah,
Wow.
call me Israel. I got 12 tribes.
Nice. Listen, in this day and time, you don't hear that anymore.
No.
Yeah.
Because my mother is one of 10,
Mhm.
eight girls and 2 boys. And
You're- I feel now, are any of your children adopted, Mark? Or are they all
No, they're all mine.
your
Yep.
poor wife?
well, I'll give all the credit to your wife then.
Yeah.
Man, she
So, yeah,
That-
what's amazing is they range from ages, let's see, the oldest is 41 and the youngest is 7. She'll be 8 in May.
Oh my
goodness.
gosh.
Wow.
That's
Man, good for you.
crazy.
Good for you. Good for you. Good for you. That is excellent. I tell you, I very rarely hear that. That's not normal.
No, it's not normal.
Mark's like, yeah, no.
I
I know it's not normal.
And here I am. I'm talking about going through the hassles. I'm going with my ex over 1.
I know, I have 2.
Yeah, boy.
All this gray hair.
I know, right?
Well, you
She's
see my gray hair. I'm starting to get it.
fantastic.
That
I also-
and that it's also
I know.
thinning. I'm pulling my hair out. So
What, 12, man? I can imagine.
Well, and that's such what an age range,
yeah.
I know,
you know?
right? Yeah.
I want to come to your family
So
reunion.
I was gonna say our family reunions are great. I come to my parents' family reunions and I've got the biggest posterity there. So,
Jeez. Your dinner table must have like 2 or 3 extensions in it. And
well, fortunately, we haven't had all of that many all at once. So, given that age range, they haven't all been there at that point in
Yeah.
time.
mhm.
Do they all live close? I mean, you're older.
No,
children?
we're all over the country. We're all
Spread.
over the country. So we're bi-coastal.
Fantastic.
So the good thing about being in Missouri is I'm about halfway between all of them.
Right.
Okay.
And my oldest son has decided he likes Missouri too. And so he moved 6 of my grandkids out here next to me. So I get to see them all the time. In fact, I got
That's cool.
3 of them over here right now running around.
What's how
Aw.
far the farthest one? How far are the farthest one away? Where are they?
Basically on both coasts. Let's see, I've got
Okay.
grandkids out in Oregon. I did have some in Florida, but not anymore. So I guess, yeah, we're mostly out on the west side now,
Oh, okay.
but they go all the way out to Oregon on the coast.
Closer to me.
Yeah, got some in Utah, some in Oregon, some in Wyoming, some in, where else? I don't remember, but that's where most of them are.
Jody, you're on the West Coast?
I'm in Colorado.
Oh, you're in Colorado. Okay.
Yeah.
Because I know there with all that stuff going out of from California, there's
Oh, that's crazy.
craziness going on out there.
All they need right now is to have a big earthquake on the San Andreas Fault and have half of California melt into the ocean. And,
I know. That's right.
that's the only
all
thing
they
that can
need.
top what's going on right now.
That's all they need. I heard, I heard the news guy say, yeah, well, they're getting all the flooding and all that. He said, but one of the things he said, but at least some of the what do you call it? Some of the rivers or basins are filling up.
Mhm.
So that's one of the, good signs in it, besides all the mess, but it's
Yeah.
one of the good signs is that they're getting the water back.
Does that mean Lake Mead is gonna fill back up and Lake Powell gonna fill back up? So,
Who knows?
I mean, those are all but dried up.
I know.
They're
right?
finding all the dead bodies and skeletons with cement boots and all that kind of stuff.
That's bad. That's bad, Mark.
Well, I mean, they're
Oh,
finding
shoot.
some amazing things. That's all I
Yeah, I
can
know.
say.
Well, they are. They are. They're finding a lot of stuff now. I keep hearing different reports and stuff they're finding,
Yep, yep.
but that's crazy. But
All righty.
Nevada, that place, well, I know we're getting into all different kind of stuff now, but out in Nevada with all the stuff that's going on, because they keep building and building out there. I think that's what started it all.
That must be all
Yeah.
those, all that building out there in Henderson and further south, just drained Lake Mead.
They got this guy who's building a $400 billion development that he's trying to start out there. The developer,
Wow.
you heard about it. He's doing like one of those utopia type things
Oh, okay.
that he's on the board to get done, to doing like sort of like what they're doing out in Saudi Arabia, that the 100-mile skyscraper.
Yeah, I was just,
Oh, okay.
I don't know what that's called, but it's something that they're doing in, isn't it in
That's the
Dubai?
big wheel kind of thing that they're
No,
doing.
no, it's called the 100-mile skyscraper.
Wow. Is it really the circumference 100 miles?
It's about 100 miles. It's a straight line.
Yeah, on the
They're
coast, right?
Yeah, right on the coast. Yeah,
I've
They're
seen
digging-
it.
they're
It's-
digging it now. They're digging it out now.
It's crazy.
Yeah,
Wow.
it is. It's amazing. It's amazing. Hey, but listen, you got that kind of money, you could do whatever you want.
Yeah,
I
yeah,
guess.
exactly. Exactly.
But yeah,
Well,
but
that's
it's
why we're setting these funds up, right? So we can do those kinds of
Yeah.
things.
exactly right. Yeah, sounds good.
All righty.
All right. Yeah, I'm good. I'm done. I think.
Good. Well, let's just say goodnight, and I'll have this posted in the next couple of days, and you can relive all these wonderful moments.
Okay. Have a good night,
All
everyone.
right,
Yeah,
guys, we'll see you. Take care.
Bye.
okay.
Bye-bye.